is run by a bunch of investment bankers, and Morningstar's tools can help make
I'm Jason Stipp from Morningstar. Anyone who's read a Morningstar equity research report knows that we're quite keen on the concept of economic moat. But just what is an economic moat? What's behind our process for assigning it? And how have wide moat companies performed? Morningstar's Paul Larson, an equity strategist and the editor of Morningstar Stock Investor, is here to give us some detail behind the moat rating and also Morningstar's wide moat indexes. Thanks for joining me, Paul.
Thanks for having me.
So the moat concept, before we start to talk about the rating, has been around for a little while. Where did Morningstar first learn about the moat concept, and how did we build it out into our rating?
Sure. Well, this is a concept that Warren Buffett really came up with in his famous article in Fortune magazine about a dozen years ago, where he said that companies that have a competitive advantage or wide economic moat are the companies that provide rewards to investors. And we read that article, agreed with the concept, and sort of took that concept to the next level. And then in 2002, started explicitly rating companies by their economic moat, putting them into one of three buckets: either no economic moat, meaning they have no competitive advantage; narrow economic moat, meaning they have something but it's not going to last quite as long as the wide moat firms, which is the third bucket, and the best bucket. And those are the firms where we think the competitive advantage is going to last 20 years or greater.
So you mentioned the wide moats are the best bucket. These are the kind of companies that we at Morningstar like to find because they have those enduring competitive advantages. We have actually identified five sources of wide moats. These are fundamental qualities that companies have. And I'd like to learn a little bit more about those. The first one I've heard you say is one of the most powerful sources of economic moat, and that's the network effect. What is that?
The network effect is an effect where the value of a given network grows exponentially with each node of the network that's added. This is perhaps best illustrated by examples. When you look at the payment networks like Visa, MasterCard, and maybe even Discover, those credit card payments are accepted because those are the actual cards that we have in our wallets. And why do we carry around those particular cards in our wallets? Well, that's what's accepted as payment. And so it's a virtuous network. Every person that takes out another Visa credit card is adding to that network and making it more likely that the merchants are going to sign up for Visa. A more recent phenomena is look at the company that's about to IPO, Facebook. Why is everyone on Facebook? Well, that's because that's where everyone else is, and it's the value of Facebook grows as more people join. You might think of the network effect as more customers join the network. It makes that network more valuable for other customers. And you mentioned that this is a relatively rare source of competitive advantage. It is indeed relatively rare, but it is also the most powerful. The companies that have this advantage tend to have relatively high levels of profitability.
So it certainly sounds like the epitome of a virtuous cycle when those network effects get going. A second source of economic moat has to do with switching costs, the cost to move to a competitor. And when that's high, that means economic moat could be wide. Can you give me some more detail on that?
Sure. I like to explain this by saying that time is money and money is time, and they're sort of interchangeable. It may not cost a customer money to switch from one provider to another. In fact, they may actually save money by switching. But if it's going to cost them time to switch, that may increase inertia and keep them with an existing provider and allow that provider some pricing power. The typical example is when you look at bank deposit accounts. Those deposits tend not to turn over a whole lot, and that's because it costs customers time to actually switch banks. They'd have to go to the new bank, fill out new forms, switch over all their information, so on and so forth. But they tend not to do that because that takes time, and again, time is money and money is time. Also, when you look at like some service firms like bank processing firms, where you have companies like Fiserv or Jack Henry that have renewal rates in the high 90% range. And why is that? Well, if you're a bank, you're not necessarily going to risk interrupting your core operations just to save a buck or two on maybe a slightly cheaper software platform. So you're going to stay with the existing platform.
Certainly sounds like the hassle factor comes in to play there. You just don't want to switch unless you absolutely have to. Another source of economic moat is a cost advantage, and I think low-cost provider often comes to mind here. Can you tell me about how a cost advantage helps a company attain a wide moat?
Sure. Well, when you have a cost advantage, this means that you can either charge the same price as the other competitors that are out there and reap a higher profit margin, or you can charge slightly lower prices and maybe try and gain some share from competitors. A couple different ways you can get a cost advantage. One way would be economies of scale. If you're just a bigger company, you can typically get things, source things cheaper and have lower overhead costs. But also if you're looking at like a basic materials company and they have inherently low costs, if they're mining a certain geology that has much lower costs than geologies elsewhere around the world, that's an inherent cost advantage, something structural to the business and could be a source of economic moat.
The fourth source of economic moat, Paul, is the intangible assets. This must be that certain something that gives a company a step up above its competitors. What kinds of intangible assets would you consider to be the kind that really give a company a wide moat?
Well, you have one that's very explicit, and this is a patent, which gives a company basically a legalized monopoly, and in certain situations, especially, say, in the pharmaceutical industry, if you have a best-in-class drug and you have a legalized monopoly, that gives you enormous pricing power. Another sort of intangible asset would be a brand that allows a company some pricing power. Now, not just any brand can be a source of an economic moat. If you have a brand for random consumer electronics, say a DVD player or something, that's not going to confer a company pricing power. But if you have a brand like a Coke or a Tiffany that allows you to charge just that little bit of a premium, that can certainly be a source of economic moat. A final intangible would be certain government approvals. If you have like a permit for a landfill or a casino license in an area where there's a limited number of casinos, those sorts of assets are intangible but certainly provide competitive advantage.
Fifth source of economic moat is one that we've identified more recently. It's known as efficient scale. What are the details behind that?
Well, this is a phenomenon where I like to explain it by saying that it's sort of like a game of musical chairs where all the chairs are already taken. When you have a company that's providing a service to a limited market and there's a relatively small number of competitors supplying that market, it may not make sense for a new competitor to enter the market because that new competitor entering would destroy the returns for all the players involved. And some markets are just natural monopolies. Perhaps the example that I like best is International Speedway, which owns NASCAR racetracks. Here in the Chicago market, we have a NASCAR racetrack. And in the Chicago market, we can support exactly one NASCAR racetrack. So if I had $1 billion, why would I build another racetrack in the market when there's already someone here? It just wouldn't make sense.
So when you're looking at these companies, you can qualitatively identify some of these factors that might give a company a wide economic moat. But for someone who wants a little bit more proof that that moat is actually carrying through to the bottom line for these companies, how can you confirm that the economic moat that you think exists in a company is really coming through in the financials?
Sure. Well, these are all qualitative factors that I've spoken about thus far. But these qualitative factors are indeed going to show up in the quantitative financial statements. And when we're looking to assign economic moats at Morningstar, where the rubber really hits the road is the return on invested capital relative to the company's cost of capital. And if a company does have a competitive advantage, it should translate to higher ROICs relative to that cost of capital. And having that positive spread is really what we're looking for. But it's not necessarily the absolute size of the spread that we're concerned about, the magnitude of the spread. We're more concerned about the sustainability of the spread. A company that has a high return on invested capital, say, a random fashion retailer that happens to get lucky and hit a fashion trend and has a 40% return in a given year, we're not going to say that company has an economic moat. It just got lucky. Where if you take like a random railroad or a pipeline company, they may not have very high returns on capital, maybe 11 or 12%, something like that. But that spread to the cost of capital of just a few percentage points is going to last for a very long period of time. And so we're going to say those firms have wide or narrow moats.
So beyond just looking at the financials of the company and considering the qualitative aspects of the company that could give it a wide moat, there's a formal process here at Morningstar that we'll go through before we actually put that final rating. Layers of folks will take a look at it. Can you describe that process to me?
Sure. We have a formal economic moat committee under our equity research business, and this is a committee that I happen to chair along with one of our vice presidents, Heather Brilliant. And this is a committee comprised of about 20 senior analysts from the equity research business unit. And we meet when we initiate coverage on a new company, the company has to go through the Economic Moat Committee and the committee actually assigns the rating. And then also whenever we change an economic moat rating, these changes also have to get the approval of the committee. And the committee, it's a democratic process, simple majority rules. Not every committee member is present at every meeting, but we do have at least 5 voting members for any given decision.
And you mentioned in there that you'll meet and talk about potential changes to ratings. So it's not always the case that a wide moat company is born on the day that company is formed. There can be some changes. A wide moat company may become a narrow moat company over time, or vice versa. What factors are you looking at that might determine a rating upgrade or downgrade?
Well, we're looking at the qualitative business aspects that we talked about. We're also looking at the returns on invested capital. If we thought initially, say 4 or 5 years ago, that a company was going to have falling returns on capital, but things have stayed pretty steady or maybe even ticked up a little bit, that might prompt a reconsideration.
Paul, one of the ways that Morningstar has used its moat ratings, specifically its wide moat ratings, is in putting together a wide moat focus index. Can you talk to me a bit about how that index is constructed?
Sure. The first thing that we do is we take all the companies that we cover at Morningstar and look at only the U.S.-based corporations that have a wide economic moat. When you look at all the wide moats in general, there's about 150 to 160 wide moat firms. But then when you cut out the ADRs and you cut out the master limited partnerships, you're down to about 120 firms that are U.S.-based corporations with a wide moat. And then what we do is we take those 120 firms and we rank order based on the price to fair value estimate metric. And what we're going to do is every quarter we're going to take the 20 cheapest on that price to fair value metric and create an index. And because we have 20 names and we equal weight those 20 names, that means every security is going to get a 5% weight. And then we're going to reconstitute the index and rebalance it quarterly. So at reconstitution, we're going to do that exercise again where we're going to look for the 20 cheapest wide moat firms and then rebalance. We're going to put every position at a 5% weight again.
So it seems to me, Paul, if you're looking at those valuations, and Morningstar analysts place fair value estimates on all the companies under coverage and the companies that have moat ratings, if you're going to look at that price to fair value, if the market sells off in a certain area, you could end up buying quite a bit of companies in that area because they've sold off, but maybe we don't think their prospects have fundamentally changed. Do you have any limits on how much of a sector you will allow the portfolio or the index to have exposure to?
As the index name implies, it is quite a focused index, and it can focus on individual sectors, out of favor sectors at any given time. For instance, 2 years ago, we had we had a 30% weight in the consumer discretionary sector. Now that sector has done quite well in recent periods, and then when you look at the index today, we have a 0% weight in the consumer discretionary sector. So the index weights can go from quite large to zero and anything in between. We're basically sector agnostic when we're creating this index, which is quite a divergence from how a lot of other active mutual fund managers think about things. They look at the S&P 500 and they don't want to stray too much from those sector weights, but again, we're sector agnostic.
I would guess that you're also agnostic as to the market cap of the company, but does the index tend to have a certain bias as far as the companies that end up in it after you do these screens?
Sure. You're absolutely right that we don't look at company size when constructing the index, but because wide moat firms tend to be large cap firms, the wide moat focus index also tends to skew towards large cap. It's a little bit, it skews actually a little bit smaller than the S&P 500. It has a little bit of a small and mid cap tilt relative to the S&P 500, but still very safely in that large cap bucket. Now, when you look at value versus growth, it also fits squarely in the core category.
So maybe the value metrics that you're considering could be a little bit different than traditional value metrics of a company that's called a value company.
Right. Well, when we say that we like values here at Morningstar, we think that any security can be a value. It's not just stocks that have low growth rates that trade at very, very cheap multiples. If you have a high growth stock that's trading at a discount to its estimated growth in the future, that can also be a value in our eyes.
Paul, can we talk a little bit about how the index has performed? We've obviously seen a lot of different market environments over the last several years. What has the index of these wide moat companies done over those time periods?
Well, thankfully, it's done exceptionally well. It has outperformed the S&P 500 by several percentage points over several different time periods, most notably since inception, which is close to 10 years ago now. So it has performed quite well over numerous time periods.
And when you look at this focused group of companies versus all the wide moat companies, regardless of what their valuations may be, is there a difference in performance there?
Yes. Actually, when you look at the wide moat firms in general, and you bucketize that particular group, that group has outperformed the S&P 500. But then when you take it a step further and you look at the undervalued securities within that wide moat cohort, that gives you an extra bump in terms of performance. So just to quickly summarize, wide moat firms have beaten the S&P. Cheap wide moat firms have beaten the wide moat firms value agnostic.
And do you have any sense of the volatility of the index and how much it potentially had lost during 2008 versus the S&P 500? What are you seeing on the trends on those squiggly lines that the index may have over the shorter periods of time versus the S&P?
Well, because the index is relatively focused, it does have a higher beta. The beta is approximately 1.2, which makes a little bit of sense when you think about how concentrated it can be in any given sector. But then when you look at how the index has actually performed, it did lose only about 42% from peak to trough in the 2008-2009 washout versus the S&P 500, which lost more than 51%. So as is true with wide moat firms in general, these tend to be more stable. So when the market falls, they tend to fall less than the overall market, which is incredibly important when you're looking at long-term performance.
So it sounds like, at least so far, the proof has been in the pudding for wide moat firms. Paul, thanks so much for giving me the insights on how we assign the moat rating and also the performance of those wide moat stocks over different time periods.
Glad to be here.
For Morningstar, I'm Jason Stipp. Thanks for watching.